Welcome back to Next Gen Investing. It's time for Under 30 as we take a look at C3AI, stock ticker AI. And joining us is George Tillis, initials GT, Senior Markets Correspondent for the Schwab Network. GT, let's talk AI. This stock we've talked about a few times over the last few years.
Yeah.
Not totally surprised to see that the stock price has diminished alongside the overall market, but it's still one that I think is going to firmly be in that growth camp when it comes to what it might be in the future. How does one assess that cohort broadly and this company broadly in the market's uncertainty of right now?
Well, look, if you just look at the stock price action, it peaked going back to December of last year. It was close to $45. So it's lost, more than 50% of the total market cap since then. Obviously, it's down in February alongside the market quite aggressively. But this is an environment where you have to consider, the best of breed in spaces, particularly in spaces that artificial AI, C3AI competes in, which is artificial intelligence, obviously. And that includes companies like Palantir, which we've talked about. That company continues to generate more revenue in terms of contract and sales. And it's also a company that's profitable. And that's, I think, the key ingredient to why C3AI has really struggled and may continue to struggle now on a relative basis to perhaps the market or even perhaps to some of the major AI competitors out there like Palantir Technologies, which is becoming a very large, not only defense contract supplier of AI technologies, but also in the private sector. They've done an excellent job in gaining revenue traction. Their market capitalization has grown, and their market share has grown significantly. Now, C3AI is actually facing some other challenges. One, it doesn't have the same kind of Department of Defense contract exposure that Palantir does. And two, it just is not near the profitability or even break-even levels that one would say is needed to, at the very least, see a continuous trend can move to the upside. You are going to see moves to the upside because of things like, interest rates coming down, hype based on speculation and so forth. But even Morgan Stanley is starting to look at this a little bit more constructive and say, look, we're going to reduce our price target on the name from $30 to $20 just because they see valuation as a challenge to C3AI. Now, they have been growing their sales. They haven't been growing it very rapidly. But the challenge is that if you just look at the earnings estimates for this fiscal year as well as next fiscal year, they don't appear to be improving all that much. And when I say that, for this year, they're expected to lose 44 cents. Next year at 41 cents. And so anytime you get closer to break even and that visibility looks more, gets closer in time, 2 to 4 quarters out, that's when you see some big moves in stocks that typically hold. I think that's C3AI. It looks like they keep pushing the envelope in terms of when they're going to achieve that profitability. And that might be based upon just standard AI models that have really cut into AI's expectations, because you have ChatGPT, you've got DeepSeek, you've got all these different AI platforms, including Google's Gemini, that have really now maybe crowded out C3AI's expected business.
Okay, and that's what I was going to ask, because it hasn't just been a tariff-related story. This name has seen some pressure now, even worse than the overall tech space. So I am curious then if we're going to see, these growth names that right now do have a relatively high volatility and high exposure to some of the various tariff concerns and also aren't flushed with cash like NVIDIA or Apple. Are we going to see some of these names continue? Obviously, I'm not asking you to make a call of what will happen, but I just look at these like second and third tier AI winners and say, it's hard to see the upside from here.
Well, I think that's a good point, Jenny. I think if you look at this company, AI, you have to say, is it first tier, second tier, third tier? I think it's probably in the second or third tier. Not saying it's a bad business. What I'm saying is that in this environment, you are going to see tremendous movements and ups and downs because of changes in interest rates, growth expectations for the macro, and that trickles down into high beta stocks like this one. It's high beta because it's effectively, in other words, that's just the volatility relative to the underlying market. The reason being is if you look at the revenues the company's generating, it's around 360 million, roughly speaking, but they keep losing significant portion of those revenues and losses, around 280 million on 360 million in sales. They have about 720 million in cash, so they have about 2.5 years of cash on the books, which is actually about 30% of the total market cap. So their cash position is robust. It just doesn't have a profit catalyst, I suggest, to keep the momentum going. Unless, again, the market turns around, this certainly could be an outperform just because of the beta or the high beta name and the low market capitalization it has.
Yeah, an example of it going the other way today is we just took another leg lower here. George Tillis, appreciate the insights on C3 AI.